What's up, everybody? Michael Silva here. It's the moment we've all been waiting for. Not the stock market brief show, although maybe some of you have been waiting for it. I'm talking about the CPI report coming out tomorrow, an hour before the market open. Oh, the last report came in at 9.1, a whopping 40-year high, and now consensus is saying that it's going to be 8.7. In today's episode, we're going to talk about if it comes in under, if it comes in above, or if it comes in just at expectations, what can potentially happen to the markets. Okay, now, first I want to preface this by saying we got a 9.1 reading. It's been on an incline. Now they're calling for peak inflation. It's coming down. Commodities have been falling. It's likely to potentially see a number lower than that. So with that in our mind, let's also think, okay, but how much lower can it actually get? Well, consensus is at 8.7. And the last couple of reports, right, consensus was 8.8, then 8.3, and then, well, we came in above those actual consensus numbers. So it's going to be most likely a hot reading from anywhere from 8 and higher, which means what? It means the Fed is still going to have to raise rates in this environment, okay? In order to tame inflation, you need to lift those interest rates, and we'll talk about what happens to the bond market if it comes in above, if it comes in below. But before we do, let's just take a look at what's taking place on the yield curve. We are now even deeper into an inversion, 48 basis point, negative 48 basis points in inversion on the 10 and 2. The 10-year and 3-month, the Fed staple, is now at 13 basis points. Like if we get some bad news or if the market interprets this as bad, I mean, we can see this inverted very soon. And the 10 and 2 is telling us that, hey, you know, the 10-year and 3-month will probably invert here at some point. And you can really see that here when we look at something like this is, by the way, this is the dates on the left-hand side. Then you got the yields right over here, the 1 month, 2 month, 3 month, and so forth down the way. And then it'll have what the yield is on these given dates. So if you just take a look here and scroll over to the 1 year, the 1 year has inverted the 2 year, it's inverted the 3 year, the 5 year, the 7 year, the 10 year, the 20 year, and the 30 year. Okay, even the 6 month, if you look at this is starting to invert the 5 year, the 7 year, the 10 year, and the 30 year. Not yet the 20 right here yet, but you can clearly see there's inversions taking place across the boards, which is just not that healthy, okay? If we take a look at this slide, the green arrow down, which means what? It means the CPI report will come in under expectations or consensus, and consensus, once again, is at 8.7. Phew. So if we write that on the screen, 8.7. If it comes in as expected, we'll be right here. Okay, so what happens if it comes in under expectations? Well, I mean, simply put, I think that the overall stock market will think that that's quite bullish and we could potentially rally. Okay, but what would happen to the bond market? The bond markets, it might be bullish for bonds. So bonds also might, you know, take liking to that because the Fed might not have to be as aggressive as everyone portrays, right? Even though that we're going to still get a high reading and we're probably still going to have to raise rates, whether that's 50 basis points, 75, or hey, if we get a hot reading, it could be now bringing back the 100 basis points to the table. Okay, so that's kind of the expectation here, and we'll go over what can potentially happen to the markets momentarily. What happens here if it comes in above expectations? Well, that could be bad for the market, and it could be potentially bearish for bonds, and we could potentially see yields obviously continue to rise. If we take a look at the 10-year yield, it has formed from a technical standpoint this head and shoulder topping type pattern. We'll see here if it wants to press up to the upside as we get this potential PMO crossover here. We'll probably see some big moves here in the bond market also, as well as the dollar. Now, if this obviously starts breaking down, well, it can start going up. Well, we already previously stated that. You look at the inverse, right? The bonds. If the yields come down, bonds could go up. We'll see here as it is putting in some sort of a basing pattern. But bonds have been very, very tricky. It's been very, very hard to get a good idea as to where they will go. So just be aware of that. Now, what happens if the 10-year yield rises? Okay, here's the 10-year up here and we fire off. Well, if we look at the relative strength line between XLK, which is tech, right? Woohoo, tech. 10-year yield when the 10-year yield rises, especially at a rapid rate of change, tech doesn't like that. And you can see that as it goes down, well, the relative strength line has moved up. So one would think if this goes up, it can very well bring down the relative strength line between XLK and SPY. Now, what happens if it goes flat? Well, I mean, it could still potentially go down as we're seeing some strains here on these mega cap stocks, especially during some very individual equities during the earnings season. Now, if we take a look at XLY over SPY, right here, it's very same situation. As the 10-year yield goes down, the relative strength line's been picking up. So if this does start firing off, it could be very bad for the relative strength between XLY and XLK, which are some very big sectors within the S&P 500. Okay, now one other thing to pay close attention to, actually one more note on that, typically financials too. Financials would benefit most likely on a rising yield, but just be mindful that it could be very well short-lived. There are actually some very good financial setups. I'm short the financials, but I have a pretty small position I've been looking to get in, but there are some actually good setups in the financials sector. But one thing that I'm a little hesitant with is financials don't really have a great history with a deeply inverted yield curve. Okay, so yeah, even though the 10-year yield rises, we're still going to be inverted at this particular point in time. So something to be very well aware of. One other thing to pay attention to is that dollar. That dollar is still consolidating here. A move stronger up in the dollar can very well impact the S&P 500. The S&P 500 has been on a big run up. The dollar's been coming down, and we can go back through history to look at these rapid rises to the upside have put a lot of pressure on the equity markets as well as various commodities as well. Okay, now we're going to get into some key levels to watch coming into this report, and then we're just going to call it quits from there, okay? So I have a couple lines here on the screen. I want you to pay attention to the orange, the blue, and the green. Okay, so first and foremost, the orange is the year-to-date anchored VWAP. You can see here on the SPY chart, we are still below that line, okay? And a lot of people have mentioned that in the cash market, the SPY, which I don't have a chart with me right here, the SPY did crack and break this high. Now in the ES, it actually did not. The ES over here is higher than this one, which is the E-minis, okay? Something to note, and then we had that reversal off that. So the year-to-date anchored VWAP, we're still below that, and what you can see here, there's not too much data, but we did crack under the month-to-date anchored VWAP here, which could indicate some more sell side, but like I said, there's not too much data as it stands right now. And then if we take a anchored VWAP to the previous bottom, if we start cracking lower, we're going to pay attention to the low anchored VWAP because that could be a level of interest to pay attention to. And that right there is at 389.35. Now, I don't think that we're going to be reaching there, tomorrow, but I will go over the expected move for earnings momentarily. If we go ahead and look at the 65-minute time frame, you can see here the first day in a while we closed below the 5-day moving average. Yesterday we were saved at the bell. Today, not so much. Now the 5-day moving average, it is still inclining to flattening out. The more time that we spend beneath it or sideways, this will flatten out even more. So we'll wait to see here if this can be a test. So 412.97, if price starts ripping up here, perhaps watch to see if that starts really taking off, but also a potential U-turn or an area of resistance where it could enter as a potential good short as this starts curling over. As it stands right now, we still have a negative divergence. Price is just chopping. Waiting for that big report. We'll probably see some big moves in the futures markets. Now, if we take a look at the Qs did try to come up and test that year-to-date anchored VWAP, didn't quite make it, and then just today, we closed beneath the month-to-date anchored VWAP. If we start breaking down further, we're going to have to pay very close attention to this anchored VWAP from the bottom, which is at 294.56. Like I said, I don't think that we're going to be reaching there tomorrow by any means, but we'll go over what the expected move is for tomorrow momentarily. Now, we did close below the 5-day moving average, so what does that mean? The very short term, bears are now in control. Okay, this is a sudden shift that's going to be hard for people to understand. We've been talking about it. Bulls are in control when it's inclining and the price is above it, closing above it. But right now, we close beneath it, and it's starting to flatten out. So right now, if it's not necessarily, I wouldn't call this extremely bearish because the 5-day moving average is still, flat to pointing up. This would be more neutral, which means what? It means don't make any dramatic decisions until there's a better entry point, whether from the short side or the long side as it stands right now, okay? If we continue on and look at the IWM did get above the year-to-date anchored VWAP. Congratulations, as the small cap squeezed very high. However, it only lasted there one single day. Perhaps we'll get back above that 192.09. But as it stands now, the IWM is still above the anchored VWAP from month-to-date perspective. It actually came down there today, and then we bounced a little bit from that level. If we start cracking down and going down further, that 175.68, which this could very well change because it's a little bit dynamic, but that range, I'll go over it more as time progresses, or if we come down to this level, that will be the anchored VWAP to this previous bottom, okay? And then that could be a level of interest where we can potentially bounce from, okay? Or if you're shorting all the way down, right, and you think you're going to crack to new lows, it's always a possibility, but you might want to consider, a reducing risk, covering or something at those levels if we continue to the downside. If we look at the 65-minute time frame, with the 5-day moving average, look at where price closed. We got bid back in the very last minute to the 5-day moving average. Oh my gosh, you gotta kind of laugh at that. That's exactly what happened yesterday, but with like the SPYs and the Qs. Okay, so we closed basically on it. It's still inclining, so I'd say this is more bullish than the other, the SPY and the Qs as it stands right now. But we'll see, because this has been obviously a big monster move to the upside, and now as price progresses or goes sideways or consolidates, that we're going to lose data from here, and the 5-day moving average is going to start calculating new data, could very well flatten out. So we'll continue to monitor that, see what develops, and see if any trade ideas can come from it, okay? From my Patreon, which, if you're in it, if you're not in it, we yesterday posted the inverse of IWM. It was a 3x trade, so you got to be careful with those, but it was TZA, it was inverse small caps, it was forming a beautiful falling wedge, and it was a nice big pop to the upside today. And for those that caught it, congratulations. But I also wanted to tell everybody in the section to make sure you're mitigating risk, because anything, it's very binary event that's taking place tomorrow. All right, let's go ahead and look at the expected move coming into tomorrow. The orange lines are the expected move. So just above 415 to the high end is what the options market, the implied volatility, is pricing in going into tomorrow, to a low of probably around, I think that's right around 406, or just right next to that weekly expected move to the downside. So if you are bullish and you're trying to be, tactical here and buy dips because you're trying to add for the long term and you believe that we're going to go to all-time highs, hey, if the market gets hit right here, that could be a potentially good entry point, right? Because it's below the weekly moving average, or sorry, it's at the weekly expected move. It's at the already low end of the CPI data report. That could be a potential good hit. And then, as the weeks progress, if it continues to go lower, you can start buying the lows of the weekly expected move, if that's your style, if that's your, your way about going about things. Now, if you're already short, you may want to consider covering something around those levels. It all depends on your strategy, your time frame, and what it is that you're looking to do. But as it stands right now, we're pricing in about just over a $5 move in the S&P 500, the SPY, tomorrow. Okay, so that is what we'll be paying attention to. Qs from the low end is actually coming outside of the weekly expected move. Okay, so a little bit hit further. All right, or to just around 323, which is still right up within all this chop as it stands there for the Qs. Volatility or volume has been decelerating here these last 3 days, or 2 days, I guess. So be careful on a big move to the downside with increased volume. That could be clearly marked distribution in the Qs, as well as the S&P 500 and even the IWM. So the IWM on the low end coming to just above the weekly expected move. So it's right about 186, just below right around 187 for the CPI expected move, to a high of about 192.50, just slightly above that. So that is those levels in the IWM that you want to pay attention to. Once again, if you are short, all right, or if you're trading a 3x fund or something, and you're short, maybe a place to cover. If you're bullish, maybe a place to potentially buy. It doesn't mean that it's going to hit here. That's not what I'm saying for certain. Or, if you're long, hey, if it comes up into this area, you might consider taking some profits and then start to wait to reposition. But the market has made an aggressive move, and we still haven't even seen digestion. Yeah, it was down 1.36% today. Big whoop. This is not a pullback. This is not really anything yet. We haven't seen the sparks fly. We've just seen it move to the upside during this whole squeeze. So continue to be careful. We'll see what happens on that report, and you'll hear back from me on Wednesday. See ya.